Hi everyone, thanks for joining for the July Endeavour video update. We'll run through performance recently, some of our contributors, detractors for the financial year and some key picks going forward, along with what we're seeing in markets and the outlook. You can see here the long-term performance of the portfolios. All Ordinaries Accum has done 9% per annum and the Endeavour portfolios between 10.5% and 11% per annum. You can also see that here, the long-term performance along with the recent performance month and quarter, significantly above the market. Now, what are we seeing in the market at the moment? First of all, inflation down to 3% in both US and Australia. So the trajectory here is much friendlier for risk assets, which is what we've seen with the rally in the equity markets. The one caveat here is trade policy, tariffs. They could potentially nudge prices higher, but that's a risk rather than an expectation from us. Away from the macro noise, AI is already lifting the outlook for earnings. We're seeing productivity gains flow through to guidance. We're seeing higher EPS forecasts on the back of higher GDP growth expectations and also AI cost savings. It's being talked about a lot by management teams. Genuine cost savings come through, which drives EPS growth higher. And this is an important structural tailwind because the market rewards companies that show free cash flow growth. Now, market leadership's also broadening. Money's rotating into smaller quality names. This is a healthy dynamic, especially after the big rally we've seen in equities over the last 12 months. Now, at the same time, central banks are easing back on the brakes. The market's pricing a 100% chance of a rate cut by the RBA in August, and futures see the cash rate down to near 3.2% by December in Australia. In the US, it's similar, although a bit slower pace, but there is 100 basis points of cuts price in over the next year. The other dynamic is passive flows continue to distort valuations. CBA is a prime example. I'm sure you all know the story, but it's trading on 30 times earnings, no growth, most expensive bank in the world, well over book value. And we see significant downside to that stock. And many small caps and mid caps with cleaner fundamentals, more compelling fundamentals are being ignored. So this is a good environment for stock pickers. We think that'll continue. But having said that, in the short term, markets have had a good run and a pullback here would be healthy. How are we positioned? We have stable industrials led by great management teams, quality global growth franchises. We'll talk about a few of these in that slides coming up. Undervaluing small caps, selected financials. We own Macquarie. We obviously don't own CommBank. We own Australian Finance Group. They're a mortgage broker. They benefit from rate cuts as opposed to rate cuts being a headwind like they are for the big four banks as they squeeze the margins. We also do own NAB, but we're trimming that position today. With zero real estate exposure, we're doing work on one name that's down 80% in 4 years. That seems relatively attractive, but we haven't completed our process yet. We also think that clients in Australia generally are overweight property outside of equities. They don't need equities for property exposure. We tilt towards a zero weighting in real estate. We have a cash buffer of 7 to 10% going into reporting season. It's always good to have a healthy cash balance into August. Reporting season creates opportunities. More and more so, we're seeing more dramatic share price movements on result days, and it's just good to have that cash buffer. Now, a couple of stocks from me before handing over to Joe and Dan for some contributors and detractors. But first of all, Zip. This is our top performer in FY25. We first bought it, which you can't see on this chart, which is just the FY25 performance. But we first bought Zip in 40 cents in December 23. Market expected zero profit growth. We thought they could do 50 to 100 mil cash EBIT. And we held this position up to, well, we traded it in between, but we held the bulk of it to September 24, just under $3. We sold on valuation and started buying back in February this year at $2.20. Now we averaged all the way down to $1.20 towards March, April low. And as a result, due to the rebound, it's top contributor to the portfolio in FY25. Management have successfully turned around this business. It's more sustainable earnings now. And due to the rally, we've been taking profits again, but remains a key holding. Similar story is Life 360. For those who don't know, it's a location-based safety app for family. It's got premium features like crash detection, driving insights, and it was up nearly 100% for the financial year. This was due to strong subscriber growth, and they started to monetize that advertising platform, which is key to the story for this stock going forward because Even after the strong rally, we can still get valuation upside in our DCF just due to that potential advertising revenue over the next 3 to 5 years. So even after the strong rally, and we have taken profits, it's a smaller weighting than it was 5, it's now around 3%. We've taken profits, but we think the stock can continue to go higher. Over to you, Joe, for SiteMinder.
So SiteMinder was a detractor for the portfolio for the financial year. SiteMinder manages inventory of hotels and links with platforms like Booking.com and Airbnb. Global travel was weaker in the year, so that saw earnings downgrades and management downgrades. But despite the short-term challenges, there's a strong moat here. Once that travel ticks up again, there's a lot of operating leverage in this business. We're just monitoring the potential travel recovery.
Thank you, Joe. And just on WiseTech, it's a new position during the quarter for the growth portfolio. It's a founder-led business, been listed for quite a while now. Recent share price weakness saw the growth portfolio re-enter that investment in May. It's actually owned it in the past on and off and traded it quite successfully. It acquired another business called E2Open, which is a supply chain software business. This will allow WiseTech to expand their offering across basically their 16,000 customers, which include the majority of the largest freight forwarders in the world. That's a good example of the type of businesses that the Endeavour Growth Portfolio is looking to invest in, sort of founder-led, high-quality recurring revenue, dominate their industry, high returns on capital.
So Telstra, Australia's largest telecommunications provider, this was one of the biggest contributors to the balanced portfolio, paid a 5% dividend over the year. The mobile segment grew strongly. There was pricing initiative which helped that segment, and management delivered on its T25 strategy, which saw some costs come out of the business. We see potential for further costs to go out of the business, given 1/3 of the operating costs is employees. We're looking forward to management revealing their next 5-year strategy.
Also worth mentioning something we have been screening for in the market, a high proportion of labour costs as a percentage of revenue, playing into that AI thematic that is going to drive major cost cutting over the next 5 years. One that is potentially in that bucket is Wesfarmers. It's a diversified industrial. I'm sure clients who will know this story well. They had Bunnings, Kmart, Officeworks, delivered reasonable returns in FY25, and they had strong performance in retail, offset the softness in chemicals, which is opposite to what most investors thought would happen over the course of the year. And then it benefited from broke up upgrade cycle and had consistent dividend growth. So that was a key contributor to the balanced portfolio. A detractor was Fortescue, suffered weaker iron ore prices we exited during the year. Although this is still on high watch, we're seeing Chinese data improve. This will benefit the pure play miners in Australia and the broader index.
The new addition to the balanced portfolio is an income-focused business, provides a 7% dividend yield. It's called APA Group. It's Australia's largest energy infrastructure business. It's got some of the most hardest to replicate assets in Australia, mainly gas pipelines and renewable energy generation assets and an underwater electricity link between Victoria and Tassie. More recently had a good outcome from the energy regulator, where basically it allowed that Basslink asset that links Victoria and Tassie with electricity to achieve what will become basically a 20-year stable investment return.
So onto the high conviction portfolio. Smart Parking was a key contributor. Smart Parking is a digitally led parking management company, and they delivered on their strategy they put out at the start of the year, which was to grow into new regions globally. More recently, the acquisition of Peak Parking sees the company enter the US, and it opens up the door to a substantial opportunity to modernize the rather dated US parking systems. We held Smart Parking throughout the whole year and continue to hold. Shares lifted just under 90%, and the company trades on an undemanding 12 times EBITDA.
Also remains our biggest holding, cheap quality global growth, the type of companies that we love to own and hold on the ASX and can really deliver some good returns with a long-term perspective. Another one that delivered a good return for us was Andean Silver. We first bought it in May 24 at 45 cents, exited the position 110% higher on a significant upgrade to its silver resource. We actually just bought back in last week at $1.20 in a capital raise. It's trading about 16% higher.
Known was a detractor for the high conviction portfolio. Known as a commercial stage healthcare company specializing in rare neurological diseases for children. The company's commercial product debut for Rett syndrome generated over $50 million of royalty revenue, as well as milestone revenue on top of that. The company has a rich multi-billion-dollar pipeline that it's de-risking through its R&D process. We continue to expect strong growth in royalty income and further milestone payments as sales begin in new regions. We also can see the potential for new indications to be announced, which adds to that multi-billion-dollar pipeline. Firefly Metals, the copper thematic has a lot of tailwinds, which we can see will be positive for the copper price in the coming years. Firefly Metals is a great way to get exposure to that. It's got a high-grade, sizable copper resource in Newfoundland, Canada. The company is drilling to expand its resource further. And the economics of this project are highly attractive. We think the project will deliver substantial free cash flow in the future.
So we've obviously talked about a few commodities positions and resources positions in the portfolio. With all of these, we stick to high quality assets, good management teams, ideally fully funded. And we have a relatively higher number than normal in the portfolio. Also not being overexposed, we're still actually slightly under the benchmark, but we have more names in the portfolio because we think this year will deliver reasonable returns for the general commodities basket. And it's a basket that's been under-owned by investors for a long time. We think about Australia, which is a resources country, is predominantly underweight resources. So you can only imagine what it's like in Europe, UK, America. We think the flows coming back into the space will be significant, especially with higher global growth. We'll just play into the hands of these resource prices. Now we move into FY26 with a healthier mix of growth, inflation and policy than we had a year ago. So we've got a tailwind here for equities. Question is always how much is priced in, but we still see upside in our portfolio because we don't hold a basket of stocks that are stretched. We hold a basket of stocks that we think there still is considerable upside to the valuation. Now, just touching on growth, the IMF recently lifted global GDP forecasts. Inflation we've spoken about, that's tracking near 3%, well under last year's peaks. We've got global liquidity increasing, and this global liquidity is increasing while growth is holding up. It's not like we're in a recession environment that requires liquidity. Growth's holding up with liquidity increasing from central banks and governments, and that's supportive for valuations. Now on the right hand here, you can see the cash rate in the RBA. We've spoken about that, expected to come down to 3.2%. So policy is shifting from a brake to a gentle accelerator, and GDP forecasts are inching higher across most regions around the world. This is driven by a few things: strong employment markets, strong real incomes, AI-driven productivity gains, and we'll get more color about the companies and how they're performing in this upcoming reporting season. So just to finish up on the portfolio, we're overweight quality growth names and pricing power, and a handful of cyclicals that'll benefit from the rate cutting environment, and some undervalued quality small caps. Cash is around 8 to 10%, and the macro lines up nicely with our positioning of growth edging higher, rates drifting lower, plenty of mispriced opportunities in the market. So thanks for tuning in. As always, if you have any questions, feel free to reach out to any of us in the team. Thank you.